Chapter 9, Understanding Inventory and Depreciation Concepts. So, this is a very strong chapter. What I mean by strong is the information, when you read it, it may not come as simple. We may have to read twice and write it out and figure it out. But this is a very important concept in healthcare finance. So, that's why I say it's strong. So, we'll go through the PowerPoint and I'll reference the book a little bit here and there. Inventory concept. Inventory includes all the items that an organization has for sale in the normal course of its business. So that makes sense. It's the current asset. So it's what they have on hand, and you have to keep up with the inventory throughout the year. And some examples for that in regarding healthcare would be what they have in pharmacies, medicine wise, the cafeteria with the food that they sell, and hospital gift shop. Uh, Interrelationship between inventory and cost of goods sold. The book does a great job explaining that. So once you review that, let me know if you have any questions. But it's when it's recognized as a cost, and then it becomes cost of goods sold or cost of drugs sold in the case of a pharmacy. So it moves out of inventory onto the balance sheet, and it becomes cost of goods sold in the statement of income. So I hope that helps. I hope that makes sense. Then that continues. Again, your chapter in the book does a good job. Figure 9.1, that helps too. And here's more. So the gross margin, this is on page 83 of the book. That's pretty straightforward. Sales 100%, and then what it costs for you to buy it, and then subtract that, and you get your gross margin from your inventory. So first in, first out, these are inventory methods. And I hope it helps you to think of, most of the time in the hospitals, actually maybe even every, okay, I don't know, I can't speak to every healthcare facility, but we use the first in, first out method. So think of it like a grocery store when you go grocery shopping and you purchase milk or cheese, or honestly everything has a expiration date these days. Anyway, it's the first one in, you want to sell it as the first one out. So they stack milk with the most recent um, current date, if you will, in the front of the cooler. If you want a milk that expires a couple of days after, you have to reach towards the back because that's how they stock it. First in, first out. And same thing with medicines. Even Tylenol expires, antibiotics expire. So you wouldn't want to receive a shipment of Tylenol or amoxicillin like you just received it this week and start dispersing that one to patients first out. That's not, I mean, yes, that's great that they won't have drugs that are expired, but the ones that have been on the shelf for 6 months, they're not yet expired either. So first in, first out. Very similar to grocery stores. Okay. So if costs have risen in the year, inventory will be higher. Okay, so I was speaking from like the medical perspective and the patient advocate perspective, but there is benefits to first in, first out with expenses. And so the book again the chapter does a good job at explaining that. Here's the FIFO inventory effect on page 84. Last in, first out, I discussed that a little bit. You can see Exhibit 9.2 in the book. Oh, there it is. Other inventory methods, weighted average, no method. No method speaks to where it just kind of gets used so fast that there's not no tracking necessary. Or it's still, you got to keep up with it for finance purposes, but it's not like the others. Other inventory method, the weighted average. If there is no method at all, the inventory is never recognized. That's what I was just talking about, the no method. Inventory tracking. So this obviously is very different per healthcare facility, but you can pick one. And as we go through these chapters with finance, I do not expect you all to be experts. Like I think I said in the beginning of this course, this is a high level overview. I just really need you to be competent. I just need you to know, like, okay, yes, I remember we learned that, because I can't tell you. I would love to be able to train you and set you up for, um, like to be an expert once you enter into your healthcare finance arena. But everybody uses different methods and everybody uses So that's why I am not really holding you to be an expert in these chapters. So just, read, review, know how to answer the questions or worksheets, and then we move forward. And that way, when you come across these ideas later in your career, you recall like, oh yeah, I remember that when I learned that in 440 or what have you. But again, please know I'm not dismissing the importance of it, but this is just a high level overview. Okay, so I got off track. Inventory tracking. There's multiple systems, different ways to track. Again, you do not have to be an expert. Sign-off forms, robotic technology. A lot of robots are used in healthcare right now because it's cheaper than paying a person, and essentially the robots take away any errors. Essentially, it's not always the case. Calculating inventory turnover. That is, yeah, page 87 in the book. Hmm. Oh, here's your solutions to the little assignments. I've caught on to that by now. I didn't realize this one had it too. But just in case this is the first video you're listening to, the PowerPoints oftentimes have the solutions to the actual assignments in the book. Although I don't assign a worksheet like this with every single chapter. But anyway, if you wanted to do it on your own to double check what you just read, here's your answers. Okay, so here we're still talking about the assignment. Depreciation concept. This starts on page 88 in your book. And depreciation is, hang on, let me make sure I get this right. Depreciation expense spreads or allocates the cost of a fixed asset over the useful life of that asset, as discussed here. And so the chapter goes on to talk about the useful life of an asset, salvage value. This gets into a lot of tax stuff. So again, high level overview, what is depreciation? Depreciation, the best example I can think of is if we buy an MRI machine, or let's just say we buy one of those Da Vinci robot machines for the operating room. Those machines cost, I'm just going to make up a figure, 100 grand each machine. So we have to write off, we get tax relief or tax credit when we purchase machines like that for healthcare, and every year they depreciate in value. They're not worth as much as they were a year later because guess what? New technology has come out. There's a bigger, better machine, etc. Very much, if I can compare, I think every one of us have a cell phone. Our cell phones depreciate in value too. You'll buy $1,000 phone this year, and in 2 years, when you're ready to upgrade or trade it in, it's only worth 100, maybe $10, maybe whatever, depending on the condition. So that is depreciation concept. It happens in healthcare with our equipment, our machines, etc. Useful life, salvage values here in the PowerPoints. Ooh, I kind of cut this one off. That's okay. Depreciation expense over the years is accumulated in the reserve of depreciation. And again, when it comes to healthcare facilities and tax laws, you kind of have to pick a method and then you stick with that type of method. So I'm not going to expect you to be an expert with methods either because I could teach you one way and just as soon as you get hired by a facility, they do it the other way. So again, net book value. 5 methods of computing book depreciation. So here we go. This is what I'm talking about. There's so many ways to do this. You will learn and become an expert at the method of your healthcare facility's choosing, and I'll save that intense learning for you for when that comes along. But please review this information. Be familiar with it. Depreciation methods continued. Okay, computing tax depreciation. Again, there's tax revenue breaks and laws involved in all this. And here's another example. So yeah, as you read through the chapters, always message me if you have any questions, and I hope you have a good week.